Okay, so last time, here we were talking about the magic of diversification. Can anybody, in a nutshell, tell me what we mean by diversification, what the magic is, the diversification effect?
The more you diversify, the lower your risk is. It balances out your risk.
Okay.
High and low.
Yeah.
To be almost non-existent.
So what it really, so the scientific way I would say it is that the standard deviation of the returns on the portfolio are lower than the weighted average standard deviations of the individual parts. And that is the mathematical effect of the diversification effect, which is what she was talking about. Okay, now let's see if you were paying attention at all. When we calculated covariance correlation, did we work this way or this way? Yeah, cross. And what do we do at the end of each one? Store 1, 2, 3, 4, right? Okay, so that last column, it's going to be a deviation times a deviation multiplied by what? Yeah, the probability of that economic state. What is the best correlation for diversification? -1. Very good. Now, does that mean, does it even have to be negative in order for it to, for you to get diversification? No. I saw Ms. Wabi shaking her head, yes. 0.99 will do it. Remember, anything less than 1. That's what we proved right here. If I throw a correlation of 1 into this formula, I get exactly the weighted average standard deviation of the individual components. But if that thing is any less than 1, then I get less than the weighted average of the standard deviation of the components. And so it doesn't have to be negative. And thank God it doesn't have to be negative, because most things in this world are positively correlated. There are a few that are negatively correlated. Most things are positive. But the cool thing is that as long as I have two things that are not correlated, as long as I keep adding stuff to my portfolio, I can continue to reduce that risk, which is a pretty cool thing. So let me give you a big portfolio example of that. You guys know what the S&P 500 is? So can anyone guess how many stocks are in the S&P 500? 500, very good. Okay, now S&P stands for Standard & Poor's, you don't need to know that, but what we can look at, we can look at the S&P 500, which by the way is a market value weighted index. Market value weighted index. Well, portfolio, when we're doing the expected return on the portfolio, we're doing market value weightings of those things in the portfolio. So if my stock is at 10% of the portfolio, it's going to be 0.10, the weight, right? So that's how we were figuring out the expected return on a portfolio. Okay, so we've got this, and it's a market value weighted index, and it's superior to the Dow Jones Industrial Average as a measure of the stock market for two reasons. Can anyone guess what they are? I'll give you a hint. How many stocks are in the Dow Jones? Ooh, try again. 41. Try again.
Is it 30?
30. Very good. 30. Okay, so we got 30 stocks versus 500. What do you think is a better measure? Do statisticians prefer a larger sample size or a smaller? Larger. Okay, so that's the first reason that it's superior. The second one is that the Dow Jones Industrial Average is price weighted, which means that a stock that has a high price pushes the Dow more than its market value would cause. And so those are the two reasons that I don't like the Dow Jones Industrial Average. And by the way, how come the Dow Jones stinks so bad? The originator of it was not a finance guy, not an economist. It was a newspaper guy. And what did the newspaper guy do? He chose 30 stocks that represented the U.S. economy, and he's added all the prices together. That's how we came up with the Dow Jones. And it drives me nuts. On TV, they're always like, well, the market was down today. And then they talk about the Dow Jones. I'm like, stop. Tell me about the S&P. Tell me the percentage the S&P was down. That's the information I need to know, not what some squirrely 30 stock portfolio has done. Okay, now, The next thing I want to point out to you is that the standard deviation on the S&P 500 index, which is this portfolio of 500 stocks, is 15.89%. 15.89%. Now, I want you to look at these stocks that are beneath there. It's kind of funny, you can tell this slide's old because some of these companies are dead. Ms. Avila, do you have a question?
No, so we're talking about the return on S&P 500 right now.
Okay, so let's address the dead elephant in the room. The stock market is taking a big dump, right? Now, and it's volatile. The standard deviation on returns is really high right now. Are any of you over the age of 30? You either are or you're
I
not.
turned 31 in November.
So you are over the age of 30.
I'm
Okay.
technically 30.
But you... You know, we could do this in probably an hour if it wasn't... Okay, back to the story. Should you care? No. I'm 15 years away from retirement. Do you think I'm losing any sleep over this? No. In fact, I'm looking at it the other way. I'm like, whew, glad prices are down. Now that however much a month that I put in there is getting me more shares, right? And it's so sad when people get freaked out because of the market being down. What do? They sell. And so, and when do they buy? When the stock's been going up for a while, they're like, oh yeah, I gotta get on this, right? And they jump in there and they buy. So they're buying high and selling low. How do you get rich on Wall Street? Buy low, sell high. They're totally missing the boat, right? So, stocks are up, great, I buy stock. Stocks are down, great, I buy stocks. Stocks are doing this, great, I buy stocks. Nuclear war, who's gonna care, right? By the way, we're closest to the nuclear war we've been since I was in high school. If you guys don't know about that, just do a little Googling. Back to the story. Yeah, there's your upbeat news for the day. Okay, now, check out the names of these companies beneath there. What do you think these companies have in common? I'll get you started. They're all part of the S&P 500. Now, take a look at the standard deviations of returns for all these firms. What do you notice about them?
Different.
They're different. He could be a detective. What else do we notice about them? Compare them. Yes.
They're all higher than the S&P.
Yeah, they're all higher than the S&P 500. Now, it doesn't have to be that way. In fact, there may be components of the S&P 500 that have a lower standard deviation than the S&P 500, but it isn't, this is a good thing to write down, it is entirely possible to have, it is entirely possible to have a portfolio standard deviation, a portfolio standard deviation that is lower than the lowest standard deviation of returns for a stock, for the lowest in the portfolio. And so it's possible to have a standard deviation of returns for the portfolio that's lower than the standard deviation of the lowest standard deviation stock. How is that possible? The miracle of diversification. It's possible because of the miracle of diversification. Questions? So let's talk about correlation, diversification, knowing what you know about correlation. Think about two stocks of companies in the same industry. Do you think their correlation is positive or negative? Positive. They are hit by the same things in the industry, so all these outside forces are impacting them the same way. And so we could say that those correlations are probably pretty high, right? What about people who are in different industries? Disney, ExxonMobil. Do you think their correlations would be higher or lower than the two companies in the same industry?
Lower.
Yeah, they kind of got to be lower, right? Because the things that impact Disney, now of course oil price impacts both ExxonMobil and Disney, but Disney gets impacted by a whole lot of other things that ExxonMobil doesn't, and vice versa. And so the correlations on those are going to be lower. What's my point to you? If you invest all in the same industry, your portfolio is not as diversified as you might think. Okay, and I'll tell you a story about my dad, but we'll do that in the next set of slides. Any questions so far? Okay. Now we're on to the next ones. Okay, first of all, capital asset pricing model, CAPM, is pronounced CAPM. So if you want to sound cool around the water cooler with your finance friends, you talk about the CAPM, capital asset pricing model. And we are going to look at two assets here. We have expected return on the vertical axis. By the way, vertical means up and down. And we have standard deviation on the horizontal axis. Expected return is a measure of return. What is standard deviation a measure of?
Variation.
Okay, but we said it represents as a mathematical measure of? Starts with an R.
Risk.
Yeah, very good, thank you. It's a measure of risk. And so what we're really looking here is risk and return, right? And so the higher something standard deviation is, the riskier it is, the higher the expected return, of course, the higher the return. If I could get a huge expected return with no risk, I would be thrilled. But we know that there's this thing called the risk premium. The riskier things are, the more they have to return. Now, let's take a look at this. We have two stocks that we've discussed previously. There's Slowpoke, and we know the Slowpoke had an expected return of 10%, and its standard deviation was 10.49%, and so it says 10.5% here. And so that's how we've managed to plot Slowpoke on this chart. And then we have Supertech. And Supertech is out there with an expected return of 15 and a standard deviation of 24.1922. So that's why they've got 24.2. So there's no mystery where those two dots came from. But then there's this square, an unlabeled square. And underneath, it says 14.93. It should say 14.95. So change that in your notes right now. Change that in your notes right now. It should say 14.95. Undoubtedly, there was some graduate student that was in charge of putting this chart together. They've been smoking weed. You know how this works. Okay, back to the story. 14.95, and it has an expected return of 13. Are those numbers familiar from our last discussion? What are they?
The standard deviation of both. Is that
Okay, both how? Yeah, it's that portfolio that was what? 40% of one and 60% of the other. Now, I want to point something out to you. If you drew a straight line between Supertech and Slowpoke, would that portfolio return be above or below that line?
The box.
Yeah, so if we draw a line between Slowpoke and Supertech, the little box would be above or below the line? Above. What this tells us is that the portfolio is getting a higher expected return than we would get if we were simply doing the weighted average of the standard deviations. You could either say it's lower risk or higher return. Either way would be correct. Okay, go ahead and label that as portfolio we just calculated, the square box. Portfolio we just calculated. Okay, now, here's what gets really funky. If I start generating every single possible portfolio composed of Slowpoke and Supertech, all the way from 100% Slowpoke all the way up to 100% Supertech, and I plotted those returns and standard deviations along a line, actually not a line, a curve. It would be that curve there. If we didn't have any diversification benefit at all, in other words, the correlation between these things was 1, the returns would be on that straight line between slowpoke and supertech. But because we do not have perfect correlation between these two, that line has a curve for it. Now, here's the fun thing. You might think, well, wait a minute, if I were really risk averse, by the way, you guys know what risk averse is? Okay, you're avoiding risk. If you're really risk averse, you would be investing at slowpoke. But would that be smart? No, why not?
Because 1 and MB have higher expected returns with lower CPM.
Oh yeah. So what's better? Portfolio 1 has a higher return and lower risk than slowpoke. And not only that, MV has a higher return and lower standard deviation of returns, in other words, less risk, than portfolio 1. And so the first one of these that I would be interested in even considering would be MV. By the way, what do you think MV stands for?
Minimum variance.
Ooh, very good. Minimum variance. Minimum variance. And then, as we increase, as we move towards supertech, we're adding more and more of the risky stock. The standard deviation of the portfolio goes up. We call that space between MV and supertech, we call that the efficient set. Efficient set. It's not efficient to invest below MV on that curve. Now, the whole darn thing would be the opportunity set, which is what's possible. Just because something is in the opportunity set doesn't mean it's in the efficient set. As my mother once told me, just because you can do something doesn't mean you should, right? You can invest between slowpoke and MV, but you shouldn't, because you can always do better by sprinkling in a little more supertech and a little less slowpoke, and that's going to reduce your risk until you get to MV.
So is everything inside the opportunity set?
We're not there yet.
Okay.
We're still on 2 assets, and while we're in 2 assets, it's only on the line, which is why we're calling it the efficient set instead of the efficient frontier, but you're getting ahead of us.
Okay.
Okay.
So on the line is the opportunity set or the
Yep.
fish? Okay.
On the line is the opportunity set. You will see when we get to multiple assets that it's more than that.
And can you just clarify what the efficient, then what is the efficient set?
The efficient set is between MV and supertech.
Okay.
MV to supertech. And this one is slowpoke to supertech. So you can invest between slowpoke and MV, but it's a bad idea. Good question. Other questions? Okay. I think I've told you everything. Oh, no. We need to talk about what motivates an investor to choose a portfolio along that line, MV to supertech. And the answer is risk aversion, which we've talked about just a little bit. Risk aversion is your desire to avoid risk. Do you think every human being shares the same level of risk aversion? No, we're all different. In fact, if you're rational, you are always risk averse to a degree. But do we also have irrational people? Yeah. Do you ever see people do crazy stuff and you're like, damn, no rational person would do that? And the answer is, you're right? Because we have irrational people. But if you're rational, you're always risk averse to some extent. But it differs from people to people. Let's talk about risk aversion and age. Who do you think is more risk averse, young people or old people? Old people. So, and it's a continuum. As you get older, you will become more risk averse. When I was 18 years old, some of my friends said, "Hey man, we're gonna go jump out of an airplane. You wanna go?" By the way, obviously I hung out with stoners. So back to the story. You wanna go jump out? I'm like, how much does it cost? They said, $300. I said, no thanks. 7 years later, one of my buddies calls up. He's like, "Hey man, we're gonna go jump out of an airplane again. Do you have the money this time?" I'm like, "Yeah, I have the money, but I also have a great job. I just slogged my way through 4 years of engineering school. I have a great wife. I have a mortgage. I am not going to go jump out of an airplane with you morons." Now, obviously, our risk aversion did not change at the same rate, right? And I understand that smoking marijuana will do that to you. Back to the story. Now, 25. Do you think I am more risk averse now than I was when I was 25? Oh yeah, 25. You're still like, "Oh yeah, let's do this thing. Let's get these experiences," like that sort of stuff. And so you're willing to do things like ride a train up to the North Korean border. And when I went to China, I'm like in my 40s, and they're like, "Hey, do you want to take a train up to the North Korean border?" I'm like, "No, thanks." By the way, the train to the North Korean border, the bathroom is a hole in the floor, and you can see the tracks whizzing by. Yeah, I don't recommend it. Back to the story. So, risk aversion, as you get older, you get more risk averse. Now, who do you think is more risk averse? Me or my dad? By the way, my dad is 81 years old.
Your dad.
My dad is staring death in the face every time he gets out of the bathtub, right? And he'll tell you, it's rough. The other day he jumped down off the tractor and now why at 81 is he still on the tractor? I have no idea. Anyway, injured himself. He's like, "I don't know." I'm like, "Dad, you're 81, stop that." Back to the story. Okay, so age is one of the things that pushes along this frontier. Now, what else do you think so two people of the same age, what else might drive differences?
Life experience.
Okay, previous experience. If you previously touched the stove, you might know that it's a bad idea, right? What else? Let's just talk about basic human characteristics.
Greed.
Say again?
Greed.
Greed. Okay, so
Willing to risk
actually
more.
greed, we'll talk, so greed and fear are what drives this thing. Right now we're talking about fear. How about differences between genders? Let me ask you this question. You see these videos on YouTube of people doing absolutely stupid things that are dangerous. They are almost always men. Men are not as risk averse as women. Men are not as risk averse as women. Now, I know this sounds sexist or whatever, and there are plenty of non-risk averse females and plenty of very risk averse males, but as a general statement, women are more risk averse than men, and this may come down to the fact that they're smarter. I don't know. Like one person heard that. Okay. Back to the story. So, my mom, who is the same age as my dad, do you think she is more risk averse or less? She's even more risk averse than he is. So, I'll tell you about their portfolios. My dad invests in dividend-paying firms. And he's investing for income because that's, how you eat when you're old, right? Now, my mom, and of course, at any house prior to 19, whatever it was, there are two kinds of money at the house. Whatever the man brings in is called our money. And whatever the woman manages to bring in is, can anyone guess? Her money, right? Okay, so where does my mom put her money? Well, she was putting it in CDs. She was so risk-averse, she's in CDs, but then the recent low interest rates had basically forced her into buying some dividend-paying stocks. But until that change forced on her, in fact, it was greed. Who said greed earlier? Yeah, there you go. Until her desire for greater returns helped her to overcome some of her risk aversion, she was always in nothing but CDs. Does this make sense? Okay, So, what's driving people along this efficient set? You should only be on the efficient set, but it's risk aversion. Risk aversion is what's driving people along that efficient set. Let me give you some examples here, and you can tell me where you think they're going to be invested. 95-year-old female.
Efficient.
Oh, there should be on the efficient set. You're absolutely right. But where should they be on that efficient set? Between MV and Supertech, where should they be? Yeah, they're hanging out down around MD, right? 18-year-old snowboarder, male. Where? Supertech, right? So you're starting to see how this works. 51-year-old finance professor. Somewhere in between, right? Does that make sense? Okay. Now let's talk about what causes the shape of that curve that is the efficient set. Actually, that is the opportunity set. And it's the correlation. If you've got a correlation of 1, the line is absolutely perfectly straight. If you've got a correlation of 1/2, you can see it starts to get a little bit of a bow into it. So there's a little bit of a bow to that line. And as that correlation goes further and further down, we see an increased severity to that bow. When we get all the way down to a correlation of -1, something amazing happens. How much is the risk? 0. How much is the return? It's positive. That's beautiful, right? No risk, positive return. And so, of course, the lower the correlation is, the better off we are. For each one of those, as we go to the left, is better, better, better. The very best would be over here on this vertical axis with a correlation of -1. However, is it possible to get 2 assets with a correlation of -1? So I'm giving this talk one night, and there's this guy, and I said no. And he said, well, what about the S&P 500 and the anti-S&P 500, which is some sort of ETF, which is designed to exactly mirror the S&P 500. I said, okay, you got me. There are actually things that are exactly perfectly negatively correlated. However, what do you think the expected return is on the S&P 500? Just take a guess. Whatever number you come up with will make me happy. 10.5, very good. Okay, so if the expected return on the S&P 500 is 10.5, what do you think the expected return on the anti-S&P 500 is? Negative 10.5. Let's hold a portfolio that is half of one, half of the other. Totally gets rid of all the risk. You must think you're a genius. However, what's the expected return on that portfolio?
0.
0. Way to go. You've got a 0 risk portfolio and you're not even earning the risk-free rate. So let me put a condition on this thing. You got to have correlation -1 and both have to have positive expected returns. You got to have correlation -1, both have to have positive expected returns, and folks, it just doesn't happen. It just doesn't happen. So don't spend your life out there searching for that elusive pair of stocks that have a correlation of -1. You're never going to find it. Questions? Okay. Now, let's apply this to country portfolios. Remember, I told you that only insane people would be invested between Slowpoke and MV. And the first time I was giving this talk, I said, oh yeah, only insane people. And then I got to this chart, or this graph, I said, oh, wait a minute, I'm insane. Here's the problem. I was invested in 100% U.S. stocks. So what we've got here is an opportunity set that is a combination of U.S. and foreign stocks. By the way, if you're an American, foreign means everything other than U.S. If you're from somewhere else, please just play along with us, right? We assume your country is foreign. I know it's not foreign to you, right? Mr. Osawago, you're not from the U.S., are you? You are? No? Okay. Sometimes I think he just messes with me. Okay, back to the story. where is our minimum variance portfolio? It turns out that it's at the 80% US, 20% foreign point, because these things are not perfectly positively correlated. Now, the US is undoubtedly positively correlated with what we call the ROW, rest of the world, but it's not perfect positive correlation. And so when we sprinkle in some of these risky foreign stocks, we are actually able to reduce the risk versus carrying only US stocks. Knowing what you know about diversification, this makes total sense. But if you ask your average retiree, should you have foreign stocks in your portfolio, what will they say? No, they're risky, right? But it turns out that sprinkling some of this risky stock into your portfolio actually reduces your portfolio risk because they're not perfectly positively correlated. Now let's discuss why foreign stocks are risky compared to US stocks. The first thing that I would point out is growth. Growth in the rest of the world is notably higher because we've still got a lot of countries that are trying to develop their economies, and so they're growing a lot faster than the US. So we have developing economies versus developed. We also have the institutions. In the United States, we have good legal protections for shareholders. And you might think that you need to go to some absolute anarchical place like, say, Somalia in order to have no protections for shareholders, but it's not true. There's actually a continuum here. And you can see that even investors in, say, France are not as well protected as investors in the US. And there may be places that are more protected than the US, but the point is there are some places where investors have very little protection. And so we're going to chalk that up to institutions. You could also say law. And then there's political risk. I'll start with an example of political risk elsewhere. The year is 1975. My dad is invested in a stock called Texas International, which, you know, Texas is in a country, I'm not sure how that works, but Texas International. And it turns out that every bit of Texas International's operations, which were in the oil field, were in a country called Venezuela. Now, let me tell you about Venezuela. Venezuela, since the late 1950s, had been riding high on an oil boom, and so there were a lot of people getting rich. Here's the problem, though, when you let people get rich. Does everybody get rich? No, not everybody gets rich at the same rate. Now, everybody tends to be better off, but not at the same rate. Now, if your income has grown, but it hasn't grown as fast as someone else, there's this emotion that takes over. Are you guys familiar with this one? Okay. Now, what happens? Politicians know, here we've got some basic human emotions. Can we all agree these are basic? Yeah, okay. Now, politicians know that people are greedy. They're rationally self-interested would be a better way to say that. They do suffer from envy, and they also suffer from fear of the unknown. So what if I, as a government, say, you know what, I'm going to come in here and I'm going to take money away from these rich people who've been holding you down, and I'm going to give you some of that money. Does that sound good? Oh yeah. Oh yeah. Woohoo! Okay. And then I say, and you know, I'm going to guarantee you that you'll always have a full stomach and a full tank of gas. How do you like that? Does that sound good? Okay. So here's what happened. In Venezuela, 1975, we had this widening wealth disparity. I think it was 75, it was sometime around that time frame. Widening wealth disparity, and so of course we get these, and sometimes they'll call themselves populists, they're actually socialists. Socialist political people would come in, and they're like, okay, we're going to do all this neat stuff for you. And people are like, yeah, Yeah, and so they vote for these people and they get in office. Now, one of the first things they did was to nationalize the assets of all the foreign companies. Nationalize. What's another word for nationalize? Steal. Did they pay for those oil rigs? No. Did they pay for the pumps? Did they pay for the drill bits? No. They didn't pay for any of that. And yet suddenly now it's up. We've nationalized your company. Oh, here's 12 cents for your trouble, right? Because then we can say we paid for it. It's all good, right? Okay, so this is one of those risks that you face when you do business in other countries. Now, as a result of that, knowing what you know, what do you think the returns have to be to get people to invest in Venezuela? It's got to be high, right? Has to be these pretty high return projects or no one's going to do it. In fact, what's going on in Venezuela right now? It's bad, right? She's a neighbor close, right?
Well, we're going on the same direction.
Oh, yeah, okay, well, we'll get to your country in a second. Okay, so Venezuela goes through a cycle. It's like every 20 years or so. Oh, by the way, let's talk about the rest of the cycle. The government takes the stuff away, and who do they put in charge? Do you think they put people in charge who know what they're doing, or do you think they put friends and allies?
Of course, friends.
Friends and allies, right? And now you've got people running an oil company that previously were like the press secretary for El Caudillo, which is like the strongman, right? Do you think they know anything about running an oil company? No, but they do know about stealing, right? Because they're part of this group that steals. And so the corruption and basically everything just goes to hell. And does anybody have any motivation to try to start a new business? No, because what's the government going to do if you start it? They're going to take it away. At the very least, they'll just tax you at like 90%. So you're like, screw it. I'll sit here and I will just collect my monthly payment and everything will be fine. Now, when everyone says that, what happens to the economy? It goes in the toilet. Now, let's ask about toilet and toilet paper in Venezuela.
Oh my God, they can.
Yeah, they don't have any toilet paper. Can you imagine a life without toilet paper, people? Oh, who said that?
Scopy did.
Yeah. Okay, so you are you from one of those cultures that uses the water and whatnot?
Yeah.
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 Okay. Can you imagine a life without your cup of water?
Yes.
It's
You
cute.
can.
I can use toilet paper.
Can you imagine a life without toilet paper or the cup of water?
No, that's a problem.
My dad worked for the Pakistani guy, and he was of the water group, right? And he would go to the bathroom before my dad. My dad would go in there, and he's like, Habib, it looks like a duck's been playing in here, because it was wet everywhere. Cultural differences. Everyone should respect each other's, hey, if you want to use your mouth, great, but just wipe the seat when you're done, please. Back to the story. Where were we? Okay, so we were talking about nationalization. And so here's the trick. Pretty soon, everybody gets really down, and they're like, you know what? This sucks. We were better off when we had capitalism. And so what do? They elect someone that promises to clean this mess up. And they do. And then businesses start to grow and flourish. But do you know what happens next? Oh, and the whole economy comes up. Everybody's better off. But what happens next? Some people start to get rich. Right? We're all doing better, but he's getting rich. I'm just getting better off. Oh my goodness. What can we do about that? And we're right back where we started. I gave this talk, and I told that Venezuela goes through this like roughly every 20 years. And I had a student from Argentina, and she laughed. She says, my country does it every 10. Does that sound about right? Yeah. Okay, so that's what we're talking about, the kind of risks that you see when you're investing in foreign stocks. Do I think that you should invest in foreign stocks? Yes. You should hold a diversified portfolio. Are there some countries that I would avoid altogether? Yes. Venezuela, right? Venezuela, Zimbabwe would be another one that I would avoid. By the way, this one might freak you out. Right now, a good place to invest? Rwanda.
Yeah.
What's going on in Rwanda?
economy is really booming.
Why is the economy booming?
The guy who's doing things.
The guy who's doing the thing.
Great explanation.
Nice.
Is it just a guy? No, it's what the guy's doing. He's putting in place law and institutions that protect investors, that protect individual rights. And this is like a new thing in that part of the world. And so he's actually, in fact, Rwanda is now they're targeting becoming the Singapore of Africa. And yeah. And so let me run you through it, where Rwanda came from. 1994, the year I graduated college, Rwanda was in the middle of a genocide, and there were like bodies and limbs and torsos floating down the major river and like gathering on stuff. So they've come a long, long way. Now, what do you think the growth rate in their economies looked like between 1994 and now? Right? Really good. Questions? Yeah.
So I've always been with like China,
Mhm.
obviously there's lots of, it's communist, but they encourage capitalism because there's billionaires and foreign investment.
Uh-huh.
I don't understand.
Okay, it's the same cycle. Roll back to 1976. Mao Zedong dies, right? And so now they've got some time to think about, And by the way, what's the state of China in that time? Are they rich or are they poor?
Poor.
They're poor. So they're motivated. And they look out and they see that capitalism can actually lift them out of poverty. But they're a little reluctant. But they do, they're stage by stage, they release some parts of the economy, right? Not the whole thing, some parts. And suddenly, people start to get rich. And the Communist Central Committee, or whatever it's called, they asked Deng Xiaoping, they're like, holy crap, we've got people getting to be rich. And what does he say? We have to allow some people to become rich first. Now, he said that in like 1979, 1980. It was prophetic, right? So we roll up through all the way up to 2012. They're still letting people get rich. And then starting in 2012, they're like, wait a minute. The rich are getting too rich. By the way, typical Chinese person, better off, worse off than they were in 1979.
Better.
Better off. I know people that were in China in 72, and they said for everyone in the family, they had one set of clothes. So if you were going anywhere, you put on the clothes, right? I'm not kidding. That's some rotten stuff. Do you think everyone in China has clothes now?
Yeah.
Yeah. So they're still better off, but wait a minute. I see these guys driving Lamborghinis and Ferraris, and that's just not right. I need to get some of that. And by the way, everything could go to hell tomorrow. Wouldn't it be great if the government guaranteed that they would take care of me? And so we're seeing that same regression. Does that make sense?
So yeah, it's so confusing right now because their economy is like suffering so much, but they won't.
Yeah. Okay, so let's talk through some of the things. I know this is not an international finance class, but number one, when you have a centrally planned economy, which they still do, you end up spending money on things that are politically favored, not necessarily things that are going to improve the lives of people. Example, there's a high-speed train system that goes out to Xinjiang, and like 5 people ride it every day. It costs billions to build. Is there any way that they're ever going to pay that back? No. So that's basically the government's having to pay the mortgage on this thing, and nobody's helping them by buying tickets. And so you see centrally planned government, they've got a lot of wasteful infrastructure spending. How did they finance that spending? By issuing debt. Who did they get the debt from? Who did they borrow from? State-owned banks, owned by the same government that is building the railroad. So everything sounds good so far, except for one thing. Whose money's in the banks? Yeah, the people's. Now, the chickens are coming home to roost. And by the way, they did this with real estate too.
Yeah, I heard about that.
The chickens are coming home to roost because these assets aren't producing enough cash flows to pay the debt. And so the Chinese people, rightly so, say, wait a minute, I might not be able to get my money out of this bank. And so they show up down at the bank and they try to get all their money out. And as of late, they've been limited to 1,000 yuan per day which is like 160, oh yeah. 100, oh yeah, you know what I'm talking about, right? Because you lived there. Yeah, it's $160 a day is the most that you can get out if you're lucky. If you're one of the 4 banks that have recently had real trouble, you can't get squat. Yeah. Okay, so then you got COVID, right? I mean, it's just one thing on top of another. It'll be really interesting to see how this all turns out. Okay, whew. Okay, back to the story. What's going to push you between this, the 20/80 portfolio and the 100 portfolio? Once again, it's just risk aversion, right? Would you invest in 90% US, 10% foreign? You shouldn't. It's inefficient. Now we are on to what you thought of earlier, and that is the extension to many assets. If I, in this blue field, don't let that bat wing design fool you. Apparently blue ink is just too expensive to continue to draw, so they just bat wing it, right? Okay, so that blue area represents every risky asset known to man. The blue area includes every risky asset known to humankind, and we can form portfolios throughout that region. And so portfolios W, 1, 2, and 3 are all part of the opportunity set. You could do any of those. They're all entirely possible. However, they would not be efficient. And in fact, now instead of saying efficient set, we say efficient frontier. Oh, I misspelled frontier there. The efficient frontier. Okay. That means I would only be interested in investing along this line that I can only refer to as being the color of baby poop. You see it? Maybe light brown would be less offensive. But anyway, so there we go. Between MV and X is your efficient frontier. Now, where would we invest? Would we prefer to be at W or R? Yeah, we prefer to be at R. We can always move up from any portfolio in that efficient, or the opportunity set up to the efficient frontier, and either gain return by going up, or we could reduce risk by going left. As a result, portfolios W, 1, 2, and 3 are all inefficient. They are all inefficient. I can tell you 2 ways to make your life better for any of those. I can either go up for more return, or I can go left for more risk, less risk. So I love more return, I hate risk. So either one of those things makes your life better. But you would not want to be invested in those suboptimal portfolios. And then, so now we say you are moving along this line, MV to X. And what do you think is pushing you along that line? Oh, come on, we've already talked about it twice.
Risk aversion.
Yeah, your risk aversion is what's pushing you along that line. Okay, now this brings us up to about 1964. About 1964. And so this is actually fairly recent, compared to the discovery of gravity, a fairly recent event that we've come into this idea of, wait a minute. Oh, and I want to point one more thing out to you. Check this out. As I'm moving from MV to X, I want you to notice that the slope at first is steep. What is slope? It's the change in, it's rise over run. So it's the change in the vertical divided by the change on the horizontal. And so in the beginning, when I move away from MV, if I take on just a little bit more risk, I get a lot more return. But what happens as we start to move away from MV? What happens to that slope? It gets less and less and less. And if I want to get another single unit of return, I have to take on more and more risk. Do you see that? Okay. Now that we've said that, it turns out that there is an asset that we've totally been overlooking. Remember that the blue field represents every risky asset known to man. But there's one more asset out there. What's it called? I'll give you a hint. It's in the name of the slide. Yeah, it's the risk-free asset. The risk-free asset. And the risk-free asset provides the risk risk-free return, and how much risk do you think the risk-free asset has? This isn't a trick question. There's a book about it. None! Which is why we've got it over here at a standard deviation of 0 with an expected return. And by the way, it's not just expected return, it's known with certainty. Remember, we said that expected return is a scientific wild-ass guess. It's like the weather forecast. But if there's no risk, then we know the return of the risk-free asset with certainty. And so we just call it the risk-free rate. And so there it is, right up there at 0 and then at a positive amount of return. And it turns out that I can mix that risk-free asset with any risky portfolio represented in that blue area. And I can connect those two by a line. And as I add more of the risky asset, my return goes up. But this time, the slope remains constant, which is a real cool thing, because remember previously, if you wanted to increase return, you had to keep taking on more and more and more and more risk, right, exponentially. Well, here, now that we figured this thing out, we can invest along the straight line, and we can control exactly how much risk we want to take for the return. The slope is the same all the way along. Now, here's how we do this. Imagine that there is a pen back here at R sub f. And I'm going to take this line and I'm going to raise it. And I'm going to keep raising it. As long as it contacts that blue field, it's part of the opportunity set. There is one last point at which this thing is possible, and that is when it is tangent to that blue field at exactly 1 point. What does tangent mean? It touches at exactly 1 point. That's what tangent means. And so when we get there, we're only going to be intersecting one portfolio. We're only going to be intersecting one portfolio in that field of risky assets, and that portfolio has a special name. We call it the market portfolio. In this picture, it is represented as A. The market portfolio is represented as A. Now, theoretically, what do we think is in this portfolio? Because I know you guys are all dying to buy it. And here's why. Because the slope of that line is the very steepest you can get, right? You're getting the absolute most return for every unit of risk that you assume. Does that make sense? So we want that line to be as steeply sloped as possible, and that's, in fact, we call that line now the capital market line. Line 2, the name for that is the capital market line. Just, it's on your slide, just make sure you circle that. That's the capital market line. And the capital market line only has 2 assets in it. It's got the risk-free asset and it's got the market portfolio. But what is this market portfolio? Get ready to write. It is every risky asset known to man. Every risky asset known to man. And when I say man, I mean humankind. Every risky asset known to man. Held in proportion to its importance in the world economy. So it's every risky asset known to man held in proportion to its importance in the overall world economy. And how do we know the importance of something in the world economy? It has to do with its market value. So if we have 100 shares and they're each 1,000 apiece, 100 times 1,000 gives us 100,000. That's going to be and then we're going to divide that by every market value of the sum, and that would give us a weight for this, just like in a regular portfolio. That's what we mean by held in proportion to its importance in the world economy. Now, there's a problem. This is a theory that we cannot test. It's a theory we cannot test, and here's why. Because if we were to try to create this portfolio, we could easily deal with the stocks that would be in the portfolio because we know their values. We could easily deal with the bonds. By the way, are bonds risky assets? They're not as risky as stocks, but they are still risky assets. Even government bonds, long-term government bonds have risk. Remember that from Chapter 10. And so we can easily figure out the returns on those bonds, the returns on the stocks, their market value of both. But what else is there out there in the world economy? What other assets can you think of? Anybody here own a house? Oh, good for you at this point. So I own a house. My wife and I own the house. And under the laws of Missouri, half the house is mine, half the house is hers. This is the theory, right? So, so that's an asset that we own. Is it a risky asset? Yes, Ms. Wabi says yes. It's so funny. When I was teaching this before 2007, students would say, no, houses aren't risky assets. Real estate values always go up. 2009, I'm teaching this, and they're like, oh yeah, house values always go down, right? And the truth is somewhere in between. But my point to you is, it's a risky asset. I lost $39,000 selling a house to get out of Mississippi. Now, I will say it was $39,000 well spent, but that's what it cost me to get out of Mississippi because house values were down. It's a risky asset. You can lose money. Okay, now the next question is this. Now that we know that my house is a risky asset, can you purchase shares in my house? No. And do we have up-to-date price information about my house? No. The only thing that we know is that that house was sold in 2007 for $354,000, $354,500. That's what we know. Is that a fresh data point? Now, that's 15 years ago, right? My point to you is this. We cannot get good value information or return information for every risky asset out there. And so there's no way for us to test whether or not this thing really works. And so that's the criticism of it. But we do know that this does, this theory is among the best explanations for what we see in reality. And so until someone comes up with a better theory, this is what we're sticking to. Okay, now let's talk about this line and investing along it. If you're very risk averse, where are you at? My mom, where's she at? Yeah, she's over here at the risk-free asset, right? She's, and by the way, let's say my dad might be at location 4. So what's pushing you along this straight line? Once again, it's risk aversion, right? And then you've got me. I am right now at location A. I don't own any of the risk-free asset. I am totally invested in risky assets, so I am at portfolio A, which is the market portfolio. And we'll talk about how I'm at the market portfolio since I can't buy a piece of your house, right? And then, so by the way, we're looking at 0% of portfolio A over here at the left. We're looking at 100% of portfolio A at A. 4 is a mixture of the two. What in the world is 5? How can we go beyond portfolio A? I'm going to give you a hint. Buying the risk-free asset is loaning money. All I have to do is get the weights to add to 1. How could I have 120% of portfolio A in my portfolio? What's the only way mathematically that that could possibly be true? What would the weight on the risk-free asset have to be? Oh, come on, you guys can certainly subtract 100% from, or 100 minus 120. It's got to be negative 20, right? Because if it were positive 20, we'd have 140%, and you can't have that, right? So, how would we end up with negative risk-free asset? if buying the risk-free asset is loaning money, Mr. Taylor, what must negative be? Yeah, what's the opposite of loaning? It's borrowing, right? And so if we borrow at the risk-free rate, we can actually have negative risk-free asset in our portfolio. And you say, okay, how in the world could I possibly borrow at the risk-free rate? Because I'm not the United States government. Well, it turns out that you can get really close borrowing on margin. Do you guys know what margin is? What's margin?
It's like using, I don't know like exactly the technical term, but like if I go to my brokerage account, I can use their money and invest it into something.
So you've got $100,000 of your own money.
I wish, but yeah.
Well, no, you got $100 of your own money. Is that closer to, yeah, okay. You got $100 of your own money. You can put it in your brokerage account and you can buy more than $100 worth of stock because you can borrow on margin from the broker. Now, the broker will loan you this money at a relatively low percentage rate because there are two things going on here. Number one, the broker wants you to buy more stock because, not Robinhood, but all brokers have typically gotten commissions for selling stock. Does that make sense? And by the way, Robinhood is making money every time you buy and sell stocks. They're just throwing you into the dark pool to be molested by other investors. But back to the story. I'll tell you about that some other day. Oh yeah, it sounds dark, doesn't it? Because it is. Okay, back to the story. It's kind of like the free drinks on ladies' night. Don't fall for that. Those drinks aren't free. Back to the story. It's gone really dark, hasn't it? Okay, so back to the story. They want you to buy more stock, and they also, they're okay loaning you money at a really low interest rate because they have very little risk. Can anyone explain to me why they have so very little risk based on the amount of money that they loan to you? What can they do?
They can just take the future returns in your portfolio, right?
Okay, so let's say that you take your $100 and you go out and you borrow another, oh, by the way, the Federal Reserve will allow you to borrow another 50%. So let's say you go whole hog and you're up to 150. And stock prices are going up, you're happy, you never hear from your broker. Stock prices start going down. At some point, when prices get low enough, they're going to call you with what's called a margin call. They're going to say, hey, you need to put some more money in because you're getting low. And if you get a certain amount of low, it starts to give risk to this debt that this money they loaned you, right? And so you say, hey man, I'm a student. I don't have any more money. Do they say, oh, don't worry about it? In a way they do. They say, don't worry about it. What we're going to do is we're going to sell enough of your stock to get you back down to where you have an acceptable level. So we're going to pay down that money that you owe us by selling your stock. Does that make sense? And so basically, as long as stock prices don't go to zero in an instant, these brokerages can stay ahead of these issues where they might end up losing money because they loaned that money to someone. Does that make sense? Okay, so you can actually borrow on margin out here and invest at 0.5 and get a return greater than that offered by the market portfolio. But we know that the risk is also higher. If you are on this 50% margin kick that we just talked about, you're also taking on 50% more risk. And when the market's up, you are 50% better off, but when the market goes down, what happens? You're 50% worse off, right? Does that make sense? Let's talk about what moves stock prices. We know stocks have an expected return, and we know that it's the arrival of news that moves stock prices. And so because otherwise, everyone's going to, if we incorporate all the information that we know into the stock price right now reflects all the things that we know. So the only things that are going to move this stock are going to be things that the arrival of things we don't know, right? Could be good news, could be bad news. Now, it's not just news in general. It's actually the unexpected portion of news. Let's say everybody expects Joe Biden to win the election in 2024, assuming he's still alive. Everyone expects that. Should there be a change in stock prices the next day if he gets elected?
Yeah.
There will be
There usually
just a little resolution of uncertainty. But will there be a bigger stock market move if the other person wins? Yeah, because that was unexpected news. Now, let's take this down to a really boring level and talk about expected return or expected earnings per share. The company says we are going to, or the analysts have said we think the company's going to return or earn $1 per share. We think the company's going to earn $1 per share. And then the company reports its earnings and it reports $1 per share. How much was the unexpected news there? None. It's exactly what we expected. Stock price shouldn't move at all based on that news. But what if the company comes out and says, wait a minute, we actually made $1.04. What should happen to the stock price?
Go up.
It should go up because of the dollar?
4 cents.
No, because of the 4 cents. We have positive 4 cents of unexpected news. Now, what if the company says, it's actually just 96 cents? Now, there's the expected news of $1 and the unexpected news of
Negative 4 cents.
negative 4 cents. What do you think happens to the stock price? It goes down. And in truth, there's actually an asymmetric effect. If we had 4 cents on the good side, you'll get a bump like this. And if you have 4 cents on the bad side, you have a drop like this. What do you think companies are incentivized to do? Underestimate. And they try to talk to all the analysts. They're like, dudes, we don't know. I'm not sure. We're not sure how things are going to go this quarter. So they try to talk them down, and then you guys are the analysts. You all say, well, maybe it's only going to be $1. And then I'm like, woo, it's $1.04. And we have a big party, right? Now, how can I prove to you that managers actually do that? 2/3 of earnings reports beat expectations. At most, randomly, 50% should beat and 50% should fall below, right? Not assuming hitting exactly. 2/3 exceed. And yet, what do analysts continue to do? Play this lowball game? Oh yeah, so there's some behavioral problems going on here, some behavioral issues. Okay, so it's the unexpected portion. Now, those unexpected portions are expected to average 0. If they didn't average 0, let's say that over the last 5 years, the unexpected pieces of news added 1% to the return of the stock. What would we do? We would revise our expectations. So previously, we expected this stock to return 10%. And it has been consistently returning instead 11%. What do? We change our expectation. In statistical terms, anyone that behaves in this way is a Bayesian, where you are incorporating new information to change your thought pattern of what you expect to happen in the future. Let's see. I'll give you an example of this. My wife and I have this Ring doorbell, and it's also our security system. And it has where you can turn off your alarm from the phone, right? By the way, my phone has a passcode on it. Don't take my phone thinking you're going to break in my house. Okay, back to the story. Every time we're on the way home, my wife gets out the phone to turn off the alarm. And it says, this is taking longer than expected. Every single time, the phone says, it's taking longer than expected to connect to your system. And my wife every time says, adjust your expectation, right? If you continuously have a surprise to one side or the other, adjust your expectation. Does that make sense? Next time, we're going to talk about two kinds of risk. And these two kinds of risk are very important for our understanding of both return and risk under diversification. See you next time.